All right. Welcome, everybody. What an exciting day today. And it's my great pleasure and honor to invite once again our good friend, Sir Martin Sorrell, to join us. Welcome, Sir Martin. And
hello, Jan. Hello, everybody.
Oh, thank you. And great to have you back here. And then we're going to go straight to business. A couple of months ago, we had a session on the marketing, and I was hoping to talk about business building and M&A, but we ran out of time. So here we are, and today we're going to focus heavily on the business building, especially with the M&A and acquisition angles there. So
okay,
let's go. So your current venture, S4 Capital. Could you tell us about the kind of like the strategy of starting it and building and growing the S4 Capital?
Yeah, I mean, I think you can sum it up in one word. We're totally focused on growth. Yeah. So the one word is growth. We think the model has shifted. In the old days when I was at Slashes or WPP, it was on a mixture of top line growth and margin. Mm-hmm. Market probably attached equal weighting to both. Now it's very much skewed towards top line growth, not in the absence of margin. So, you know, I'm 76, so I'm an old man, and therefore I didn't want to be burdened by fighting with a flat top line anymore. So I wanted to focus on top line growth. So that's one thing. So we want to create the new model, mm-hmm. the new advertising and marketing services model, and disrupt the old. We're very much disruptors, use grand examples like Tesla or Amazon. Mm-hmm. So we're disrupting the industry, and we have four basic principles. We're focused on digital because that's where the growth is. Mm-hmm. It's half the market. It will be 70% by 2024. Even last year it grew. We grew by 20% organic, and you see this year in the first quarter we're up over a third. We're up about 35%. So we're that's organic and reported about 71%. So that's the first. The second thing is we have a data-driven model, mm-hmm. which focuses on the creation, distribution, production and distribution of digital advertising content and data and analytics and digital media who distribute it. We go to market as faster, better, cheaper. So agility, understanding the digital ecosystem and being efficient, particularly in a zero inflation or close to zero inflation world, although there's a controversy as to whether that lasts. And then finally, we have a unitary structure. So we're one P&L, no cross-charging, no separate businesses. The old advertising holding model, in our view, is busted because it's too vertically driven and not one firm. So that really is the strategy, and we executed through Media Monks the middle of 2018, injected that into a public company on September the 12th or 13th of 2018, and then Mighty Hive in December 2018. We've added 21 companies, 11 to content and 10 to data and analytics and digital media. And we're now 5,500 people in 31 countries with a market cap of well over $4 billion now. So we've done very well in a short period of time. We were a unicorn within 1 year, which is is unique insight in the industry.
For sure. So basically, when you started the company on the day one, you were ready to do some acquisitions.
Well, we had nothing. We had a pot of money. I put my own money in, which I think is critically important. You know, I believe making sure that ownership and management are one is absolutely mm-hmm. critical. You know, the people who run the holding companies, for example, have no financial interest. It's just a job for them. You know, I still have more shares in WPP than I think the whole board put together by some substantial amount. So they're not really interested in the business or the company. They're interested in retaining their management position. Mm-hmm. And I think bringing ownership and management together is critically important. But we had nothing. So we had to grow by acquisition or merger, as we call it. Very important. You know, call it M&A, merger, A is acquisition. We bring partners together. You know, we bring people together who want to share our vision about building a new model and disrupting the old. and want to join us on that mission. I mean, we will never be the best price in an auction. We are always going to be saying, I mean, we just had a couple of negotiations recently, and we're signing up exclusive LOIs where we've said, look, if you want to join us on our mission to create the new company or the new model and disrupt the old, join us, but we're not going to pay you. You know, it's half shares, half cash. You can take half of it off the table if you like, but you invest the other half in us and developing the business.
So, okay. So when you come up with like a big vision of the deal, like how do you come up with it? Like okay, we need this or we need that market or like that. What kind of?
When we started, we said we were going to focus on that what we call the Holy Trinity. So data-driven content, data analytics, and digital media. So there really were two parts to the business. One was around content, which is 70% of our business now, and the other is data and digital media, which is 30%. Interestingly, I think we will probably be expanding into a third leg around technology services. We're not an ad tech company or a martech company. We our criteria for deals excludes. We deliberately avoid anybody where we have a technological vulnerability. So I'll tell you the criteria when we look at mergers: top line growth, margins, or a path to strong margins, meaning 20% plus in EBITDA. We look for no exposure or little exposure to technological change because we're part of the service layer. And then the fourth point is management must own a very significant chunk of the business because of this point about ownership and control. Bringing the two together is very important. Those are our criteria. So what we're trying to avoid is any technological disruption to our own business. We know over time you'll always face disruption because of digital transformation, but we're really avoiding technology.
Okay, and how do you then balance, like when an M&A, there's sometimes acquiring talent and acquiring market share? So how do you balance that?
Well, I think the old model, the WP model of Saatchi, was about market share. You have different businesses that competed with one another. They might have different clients and different client base, but basically it was about market share. S4 is not about that. We're in the digital marketplace. That's about brain, not about brawn. So we're more focused on developing. I just had an interview today with one of the trade magazines where we made it quite clear that where we see the opportunity is to build our technological capability and understanding. So the people we hire come from the tech platforms or the software companies or the hardware companies. They don't come from the traditional holding companies. That's where we're really focusing our interest and our development. So that's the way we really go about it. That's our vision is really to create that new model and disrupt the old. And we're looking for people. If it sounds messianic, it is. I mean, we are men and women on a mission.
Yes.
And we're determined to disrupt the existing model.
Great. Is there something when you're preparing to acquire a company, you already put like a few things there on your checklist? Is there something specific you want when you're creating a checklist and acquiring?
It's always in human capital. I mean, you look at our, we will be getting close to $1 billion of revenue this year. The market is expecting us to do about 850-900 million, and with a fair wind, we may well get, if we continue to add organically. We have our AGM next week on Monday, and we'll be making a statement about the first third of the year. We had the first 3 months when we were up 35% in gross revenue and 33% in net. And you'll see, the business has been very strong in April and May, and it looks as though it'll be a strong year for us. Certainly, we've raised our guidance. We started the year at 25% guidance, organic. We've raised it to 30 already, and we'll see what happens next week when we're at the AGM. But we really invest in people. And if you looked at our $1 billion of revenue or close to it, it's about 600 million a year that we invest in people. And that's the critical, coming back to your question, that's the critical investment we make. So it's really a judgment on the quality of the people that you're getting in bed with, if I can put it like that. Yeah. So the quality of the people that you're merging with, because our model is a merger model. It's not an earn-out model, which creates too much fragmentation. Remember, we're a unitary structure, so we're focused on bringing everything together as one. And that means that we're really focused on getting the best people together. And it's not easy because entrepreneurs, good people tend to be difficult.
Yeah.
And the great good people or the great entrepreneurs are the ones that are cooperative, who are team players. And that's critically important.
All right, let's move to the closing the deal part then and go a little bit of details. I'm curious to know, like from your experience and when you are making an acquisition offer, like what kind of things, what triggers the yes from the selling party?
Well, it depends on what their motivation is. And we're looking for people who want to buy in and not sell out. So we will never be the biggest bidder. I mean, when we bid for Media Monks, WPP, who I left and they were trying to stop us. They bid a maximum of 1.5 billion euros for Media Monks. And we did our deal at 300 million. Now, it is true because of the rise in the S4 share price that probably the consideration that the Dutch principals, Wes and Victor and their colleagues received was, let's say, 1 billion. Wasn't 1.5 billion, but that was not guaranteed at that time. So here they had the opportunity. So the answer is they chose us because they fundamentally believed in what we were doing. They didn't take the king's shilling, as we say, or the queen's shilling.
Yeah.
What they decided to do was to buy into, and that's what we're looking for. We're not looking for people who want to sell out.
Yeah.
We're looking for people who want to buy into what we're doing, create the new model, and disrupt the old. So that's absolutely critical. So, I was thinking about, you sent me the questions kindly before, and I was thinking we were having a discussion actually over the weekend about something. And, probably the reason why people say yes is that they understand it's not the quantitative side. I mean, you have to get to a certain level financially. You can't have an offer that is way below market, but you can be below market if you offer a future. And I think that's the critically important thing. And I think these negotiations tend to get tough. People tend to get emotional and angry sometimes. I think that's a mistake. And it's interesting when you say what delivers I think tone is really important. And I think a constructive tone is far more better than an adversarial tone. The trouble with lawyers and bankers is they tend to become confrontational, and principals tend to get separated from the advisors, and I think that's wrong. So I think the key thing is to have a strong point of contact with between the principals, because the advisors can take you off. I mean, I don't want to upset or insult any advisors that are watching or that could watch, but I think it's a real issue. And I think if the principals have a lot of communication, constructive communication, not adversarial communication, it has to be constructive. Yeah. I think that sets, and particularly for our business, which are about mergers. We don't do acquisitions, we do mergers. We call them mergers or combinations. From an accounting point of view, they're acquisitions, but from a philosophical point of view, they're mergers and combinations. We're trying to bring talent together for a common purpose.
Exactly.
In one company, not fragmented, not separation. You don't come in here and run your company separately. That was the old model. It doesn't work. Yeah. Clients want everybody. Like today, we had a session with one of our new clients in Brazil. And it turns out that I knew the client from India. He was actually in India when we spoke to him today. Mm-hmm. And he knew one of our people who started our business in India and used to work with me at WPP. So the point of the story is that there are all these interpersonal connections which you're trying to develop and exploit. And so I think a constructive, direct negotiation is critically important. Don't become a prisoner of your advisors.
Mm-hmm. Yeah. And then if you kind of like sometimes, of course, there's some hesitancy on the founder or the other principal there. Have you seen some kind of when you feel like, okay, now the other part is like a little bit slowing down or calming down or like getting scared or something, not confident? What's the best way to get them back on track with the deal?
Well, I think transparency. I mean, when I was at WPP, it was a different system. I used to insist that nobody had contact with the deal, with the let's say the acquisition until after everything was done. What we do now, because we're one company and one brand, it's very important that, so for example, we have signed an exclusive, and we were talking today on our daily management call about how, and the process will take a couple of months, 6 weeks, 8 weeks, we will start pitching together.
Yeah.
So we will start the integration now. And we have another company where I think we're about to sign another exclusive where we will do exactly the same. We will be working together immediately, despite the fact we haven't got an agreed contract and we haven't got an agreed due diligence, or the due diligence hasn't all been done. But, to your question, because our structure is unitary, it's so important, and they are mergers and they're not acquisitions.
Yeah.
To make that quite clear, we bring everybody together from the very beginning, and we make sure that the 8 people that are in the key management team, that they are all fully aware of what's going on and can start to contribute immediately. So the integration process starts from sort of 0 minus 2 months.
Wow.
Because usually the due diligence and the SPA, the sale and purchase agreement, takes about 2 months to do. But we believe we should get together much more quickly.
And then just very quickly on you already referred to half cash, half equity, and then how do you see the best practice on the financing the acquisition or the merger in this case, obviously?
Well, it depends. It depends on, we have been debt free for the first 2.5 years. We're negotiating a term loan now because I think it's time for us. You can borrow long now at very low rates still, or that might not be the case in a few years' time. So we think, going to the capital market, we wouldn't go to a debt to equity ratio of more than about 1.5 to 2 times. So we're not as crazy as private equity, or we're not as driven by debt as private equity. But I think a balance, particularly in our business, a balance between equity and debt is good. But to date, when we raised 113 million pounds during the pandemic in July, and that was very successful. We've deployed all that.
Yeah.
So on all the deals that we've done, and we have more to do. So we're going to take a little bit of leverage. We're probably going to negotiate a term loan of about $350 million, and maybe a little bit more. Our market cap, as I said, is 4 billion, well over 4 billion now. So we're in a decent position. But I think the answer to the question is a judicious blend of debt and equity.
Yeah, to have them aligned interests for the future also. It's
right.
Important. Yeah. And then, a little bit about when the deal is done and the merger is happening or has happened, and so basically post-merger time. And then we know, of course, from the past that a lot of these things fail. And like on average...
we don't have earnouts. And I think the earnout is a great, basically you pay a bit down and then you pay money based on performance over 5 years. That theoretically is good for people, businesses, or businesses where the assets go up and down in the lift. But what it does is it creates almost a false market. And then when the earnout is finished, the principles may decide to go away. I mean, people change.
Yeah, of course.
People grow, you know, their careers change, their objectives change, they get married, they get divorced, you know, all sorts of things. People, they have kids, their priorities change. So it's natural for human beings to change their views. But having said that, in this day, in a 24/7, always-on world where you need instantaneous responses, having one company together is critically important to execute, because agility is so important. And I think you have to bring everything together. So integration, as I said to you before, starts at 0 - 2 months.
Mm-hmm. Yeah, that's a really good way.
The company that we signed with last week, you know, we were saying today, let's start pitching business with them, because that's what we think is the best thing to do.
Yes, of course, you want to improve the success rate and integrate as fast as possible there. And but you've been out there doing mergers and acquisitions for decades already, or was there something you pinpointed? What could be? Is it in the other principle, or how could you improve the success rate? And is there something that definitely didn't work that you tried?
I think it's critically important in our industry. Might be different in other industries. I mean, we focus, ironically, we're focused now on revenue synergies. Revenue synergies are unpopular because they're so difficult to measure. And if you read in the Financial Times or Wall Street Journal about an acquisition, you know, they take the prospective cost synergies and they apply a multiple and they try and value what the added value from the deal is. When you get to revenue synergies, people get very nervous. They think revenue synergies, but revenue synergies at the end of the day is what it's about. And that's where we're focused on. So having a merger structure, you know, half shares, half cash, means that the merger partner has the opportunity of sharing in the benefit of the synergies, whether they be cost synergies or revenue synergies. So if you say, you know, half shares, half cash, you merge for £100 and 50 in shares and 50 cash, you know that if you can drive synergies, revenue or cost, into the combined company, you will get the benefit of at least half of that as it flows through to the P&L and into profit. And by the way, if somebody said to us, instead of half shares, half cash, they'd like to do 100% shares, we would do it. We would not go higher than 50% cash.
Cash, yeah.
But we would certainly go 100% equity, because we think that's what we're looking for. We're looking for commitment and not a quick hit.
Yeah.
And you know, sell and disappear. We don't want that.
Yeah. Well, that sounds wonderful. And then, of course, let's say that we talk about somebody who doesn't have any experience in acquiring or selling their company. You already referred to the who talk to first.
In terms of what?
To be on the safe side, who do you want in your corner when you go then talk to the other party, or you're planning to sell, or somebody wants to buy your company, and like
I think
lawyers or bankers, or would you talk to somebody who's done?
There are very good lawyers, there are very good bankers, there are very good advisors. But you know, my dad said to me, you know, find an industry you enjoy, build a reputation in that industry. If you want to go and do something on your own, do it. Yeah. But do it. You know, I think, look, the best advisor, you always have to have somebody that you can talk to. You always, you know, that you can talk off the record, who has no agenda other than your interests at heart.
Exactly. So a mentor rather than a lawyer or a banker.
Yeah, that would be probably the best way to do it. I mean, there are very good lawyers and very good bankers you can talk about, but you know, you want somebody who has no vested interest or but other than your interest. And you know, used to be my father, used to be a lawyer I knew in New York, and I think that's very, very helpful. But I think the best thing is experience within the industry in which you're operating in. and looking at that experience and using it to evaluate the quality of the people you're merging with, the quality of the clients they work for, their reputation. You know, you can talk to journalists, you can talk to clients, you can talk to technology partners, software companies, hardware companies, the platforms. You know, we go to a lot of our partners in the industry, the big tech companies, and we ask them for their view. You know, we've done most of the things we've done. We have asked our technology partners for a view as to whether they thought it was a good idea or not. And so I think when you say, you know, people inside your company, I mean, like this morning, I do a weekly email, and, you know, I ask people for who do they think is doing a good job. You know, a woman wrote to me this morning and with some ideas in the pharma area, which were very interesting. And, you know, we had a dialogue about what. So I asked people, you know, what technologies do they think we should be looking at and understanding, what companies that we're competing against are doing a good job. And, you know, you ask a client, it's information for free, and they know, because they, you know, they're clients who agencies, for example, talk to all the time. So there's a lot of free advice out there, which is good advice. But I think, you know, you should always have somebody that you can talk to. It can be your father, your mother, or your wife, or your partner, or whatever it happens to be. But I think we should have somebody who probably has got dispassionate advice. And then there are the lawyers and the bankers, but they charge inordinate fees, so you have to be careful.
Yeah. So they are not purely somebody who's close to you and don't have a special interest there. So
that's right.
All right, I think we're running out of time. Maybe very quick one. And then we're gonna have to wrap it up. Is there something in the financial markets that excite you at the moment, like SPACs? It's been pretty hot.
SPACs. I looked at SPACs when I started S4. I don't get it. You know, promoters. The only people who get it are the promoters. They make, you know, 20% or 8% average, whatever. I don't get it. I think it's unduly speculative and risky. So, you know, we injected Media Monks. I had a private company. I put money into the private company. We did our deal with Media Monks. Then we put Media Monks into Deriston, which was a quoted shell, which is now S4 Capital. You know, I think that's the best way of doing it. I mean, we did our deal with Deriston at 87p. The market price is about 560 now. And, you know, we did a fair deal, which we valued us at the asset value of Deriston. It was a cash shell. They wanted a premium, and I said, no, it has to be done at asset value. And it was fair. And, you know, we've done very well, touch wood so far. We've got a long way to go. And as I say, we're up to a market cap now of $4.4 billion. So we're motoring, but we've got a long way to go. Super.
Hey, it's been honor and a fantastic, and digging just a little bit scratch surface on your M&A strategies there, but I'm sure this one gave a lot of good pointers to everybody watching. And
well, anybody wants to talk further on it, Jan, just to prove that there's anybody listening or watching, Martin at s4capital.com. By all means, send me an email.
Boom, there you go. If you need some M&A advice from a neutral person, there you go. Sir Martin, it's a pleasure. Thank you so much for your time.
Thank you very much, Jan.
And,
good luck to you.
Looking forward to meeting again in person somewhere.
Absolutely. And thanks for the opportunity, and good wishes to everybody. Thank you very much. Ciao.